Hello and welcome to my channel, Ledgers and Logic. Here I try to break down commerce for you in an easy manner. Today we'll be starting with the topic cost of capital. Generally, the common sources of raising capital is debt, preference shares, equity shares, and retained earnings. So we would be taking up the cost of each one of them one by one. We would start with cost of debt. So cost of debt. Generally हम समझते हैं कि the amount which we pay to the debt holders, which is interest, is our cost to debt. For example, if we pay 12% interest to our debt holders, that will be our cost of debt. But actually that is not the case. Let us observe the situation. दो कंपनी है, company A and company B. Both the company earns an equal amount, that is their EBIT, interest before earnings and taxes, are equal, 10,000 each. But one company uses debt in its capital structure, and the other company uses equity. So company A is raised debt of 6% for suppose at an interest rate of 6%, and company B uses money raised by equity. So when we calculate further, when we subtract interest, so 6,000 interest paid by company A and none. And then when we calculate EBT, we get it 4,000 and 10,000 respectively. Then when we subtract tax at the rate of 30% for suppose. So here we get 1200 and here we get 3000. And when we see the net amount, which is EAT, earning after tax, we get it as 2800 and 7000. So when you observe, the difference between interest expense of both the companies is 6,000 rupees. So anyone would say that the difference between the profits of the company would be 6,000 rupees net. But when we observe the net amount, that is the earnings after tax, the difference is of 4,200 rupees. This is due to the 1,800 rupees difference in the tax amount. So company A paid less tax than company B. And this happened due to the expense amount which the company A had, which due to the interest amount which the company A had. So the interest reduced the taxable profit of the company A and thus reduced the tax amount paid by the company A. And this concept is known as tax saving. So due to tax saving, the cost of debt reduces. So the interest as it is not the cost of debt, but it is adjusted by tax. So we can say the cost of debt, which is represented by KD, is interest adjusted by tax whole upon PV. PV is the amount which we receive from raising the capital. जितना हमको नेट में मिलता है जब हम कैपिटल रेस कर लेते हैं, दैट इज पीवी. तो पीवी के अलग अलग सिचुएशंस होती है क्वेश्चंस में. विल डिस्कस ईच वन ऑफ देम. There could be several situations given, and there is a preference list according to which you have to calculate your PV. So the first preference is always given to net proceeds, which is net proceeds is the amount which we receive after subtracting flotation cost. So suppose we are whatever price we are issuing a security minus the flotation cost is what the net proceeds is. And if you talk about what is issue price is the face value adjusted with the discount और प्रीमियम as the case may be. अगर आप प्रीमियम पे इशू करेंगे तो प्राइस बढ़ जाएगी, ऐड हो जाएगा, एंड अगर आप डिस्काउंट में इशू करेंगे तो प्राइस कम हो जाएगी, सब्ट्रैक्ट हो जाएगा. Then comes market value. The market value is the value of our security today in the stock exchange, on a recognized stock exchange. And face value is the amount given on which we calculate interest. So the first preference is given to net proceeds, second preference is given to issue price, third preference is given to market price, and lastly, if nothing is available, we take face value as our PV. This is for PV I'm talking about, right? And so this is the formula of cost of debt, but this is the formula when the debt is irredeemable. But generally the debt is redeemable. So when the debt is redeemable, एक और फैक्टर आ जाता है टैक्स के अलावा. जैसे इरिडीमेबल डेट में देयर इज ओनली वन फैक्टर विच इन्फ्लुएंसेस द कॉस्ट ऑफ डेट, विच इज टैक्स रेट. सो इंटरेस्ट के साथ टैक्स एडजस्ट होता है, बट रिडीमेबल डेट में एक चीज और एडजस्ट होती है, विच इज द अमाउंट डिफरेंस इन अमाउंट विच वी पे एट द टाइम ऑफ रिडेम्पशन. आप रिडेम्पशन के टाइम पे प्रीमियम पे भी रिडीम कर सकते हो, पार पे भी रिडीम कर सकते हो, एंड डिस्काउंट में भी रिडीम कर सकते हो. सो इफ यू redeem at premium, then you are paying something extra, so your cost increases. And if you are redeeming it at a discount, your cost decreases. So likewise वो फैक्टर को भी एडजस्ट करना रहता है, so उसमें फॉर्मूला चेंज हो जाता है. So again, KD here becomes interest adjusted with tax, but here the difference between the RV and PV is also taken into consideration, amortized over the life of the security. अगर 5 साल के लिए life या security can we are paying 10 rupees extra. So 2 rupees every year we add, and that is what the logic is. And नीचे में then now there is a confusion. Should we take PV? Should we take RV? So what we do is we take an average of PV and RV, right? So this is the formula of cost of debt in case of redeemable debt. Here, PV remains the same as we discussed earlier. We take it as net proceeds, issue price, market price, and face value. And RV, redeemable value, will be given to you in the question as the security is being redeemed at 5% premium or a 5% discount. So, redeemable price will be given to us in the question. Now let us solve some questions for getting a better understanding of cost of debt. So this is a PDF I've prepared, and I will give this in a Google Drive link in the description, and this will also be available in the pinned comment, so you can check it from there. It has all the type of questions, covers all the categories. So firstly, we have a question of non-convertible debt. There's a company who wants to raise funds of 100 lakh rupees. It has two methods. One is institutional loan of 14% interest, and one is 13% non-convertible debenture. The loan option would not attract any incidental cost, so there is no flotation cost in the case of loan. But the debenture would have to be issued at a discount of 2.5%. So it is so we are given the information about discount, so we can find out issue price from here. As we as no face value is given, so we would consider the face value as rupees 100. So rupees 100 is the face value and 2.5% is the discount. So the issue price would be 97.5, correct? Then it also says that there would be an additional cost of 1 lakh rupees on the issue of debentures. So this is a flotation cost given to us. So 1 lakh rupee flotation cost on a capital of 100 lakh rupees. So that means 1% is our flotation cost. So we would subtract that also, and we will calculate net proceeds because it is a possible in the question to calculate net proceeds. So we would take that. So 97.5 rupees minus 1%, which will give us 96.5 rupees. Now we have to advise the company as to what is the better option, by either by taking loan or either take debenture, and the tax rate is 35%. So let us solve this question. So it would go, firstly, let's calculate the cost of term loan. So the formula would be interest adjusted by tax divided by PV. So tax is for interest rate is 14%. Tax is, as we saw, 35%. So I will write it as 1.35. And here PV would be 100 rupees as there is no flotation cost involved in case of term loan. So this I suppose would come around 9.1%. So now we would calculate cost of debt. So interest remains at 13%. Tax is same 0.35. And here PV changes as face value is rupees 100. There's a discount of 2.5% and there is a flotation cost of 1%. So it gives me 96.5 rupees as my PV. So when I take this as 96.5, my cost of debt comes to around 8.756 something. So round it off to 8.76 percentage. So this is my cost of debt in case of debenture, and this is my cost of debt in case of institutional term loan. So we should advise the company to go for debenture as it has a lower cost in capital. Now let us solve a question of redeemable debt. Question number two is of redeemable debt. So here we see there is a company needs to issue 100 lakh rupees, 12% debentures of 100 rupees each. So the face value of the debenture is 100 rupees given to us and redeemable at a premium of 5% after 5 years. So यहाँ पर we have been clearly said कि the debenture is to be redeemed after 5 years at a premium of 5 rupees. So that means कि the debenture जब हम पैसा वापस देंगे debenture का when the debenture would be redeemed, so we would pay 105 rupees and the debenture would be redeemed after 5 years. The tax rate is 40% and you have to calculate the cost of debenture in each of the cases. First case is debenture is issued at par. So here the RV is given to us as 105 rupees PV changes in every case, and we have to calculate the cost of debt. So in first case, PV is at par. The debenture is issued at par, so PV would remain 100 rupees. So when we calculate cost of debenture, interest is 12%, tax is 40% divided by 100, and the difference between RV and PV, which would be 105 minus 100 rupees. The life of the security, the debenture is 5 years, so we would take 5 years, whole divided by average of PV and RV, correct? So when we solve this, we would get it as 12 into 0.6. So we would get it as 8% cost, right? Then let's move to case number B. Case number B says debentures are issued at par with 5% flotation cost. So now the debentures are issued at par, but there's a flotation cost of 5%. So here we would take PV as the as the net proceeds, which would be 100 minus 5% flotation cost, resulting in PV of 95 rupees, right? So when we calculate cost of debt, it would be 12, 1 minus 0.4 plus 105 minus 95 divided by 5 years, whole divided by average of RV and PV, right? So when we solve this, we would get it as 9.2% cost of debenture, correct? Now, let's move on to the third case. The third case says that debentures are issued at 10% discount with 5% flotation cost. So now there is a discount and flotation cost. Here, the important thing to note is that flotation cost is always applied on the issue price. So first we have to find out the issue price, then we would calculate the net proceeds. So here the issue price would be 100 rupees minus 10% discount, which is 90 rupees. And then we would calculate net proceeds, which would be 90 minus 5%, which will be 85.5 rupees. So this is our PV. So when we calculate cost of debt now, it would be 12 rupees interest, 1 minus zero point 0.4 plus the redeemable value, which remains same as 105 minus the PV, which we calculated just now, divided by 5 years, whole upon average of PV and RV. So when we solve this, this gives us a result of approximately 11.65 percentage, right? So this is the cost of debt in each of the cases, and we have completed this question. So here we complete the topic of redeemable and irredeemable debt. Now let us understand convertible debt. So sometimes when at redemption, we are given an option by the company to convert our debt into equity shares rather than taking cash, right? So here nothing much changes. The formula remains the same, but here the redeemable value which we take in the formula needs to be calculated. In previous questions, we would have been given our redeemable value in the question itself, but here we need to calculate it by ourselves, and it would be calculated as RV would be taken as higher of the following, right? We would take the higher option, we would choose the option with maximum value. So the first option would be cash. Okay, we take up the uh, cash as we used to do. Normally, we would redeem our debenture and we take in cash of equivalent value, or we take equity shares of the value which is provided by the company. So we have two options to take cash and to take equity shares. It is very normal that a rational investor would choose the higher of the two. So we would take the redeemable value of higher of the two. We would calculate the value of equity shares as were relevant to the data given in the question, and the value of cash is always the value at which the debenture would have been redeemed. So we would take the higher of the two, and we would calculate our RV, and that we'll use in the same formula: interest 1 minus T plus RV minus PV upon N upon RV plus PV by 2, and we would calculate our cost of debt. So let us do a question of this to get a better clarity. Question number 3 is of convertible debt. So let's solve question number 3. Question number 3 says SK Limited is issuing 10 lakh debentures of 12% convertible, face value 100 rupees, and they are redeemable after 6 years. Another time of the redemption, the holder will have an option to convert the debentures into equity shares of the company in the ratio 1:5. This means that if you are holding one debenture, you'll get five equity shares of that company if you choose the option of equity shares. The current market price of the equity share is 22 rupees. Today, the market price of the equity share of the company is listed at 22 rupees and the debenture is 120 rupees with flotation cost of 4%. Historically, the equity shares of the company grow by 6% per annum, and if income tax is 30%, calculate the cost of debenture. Now, what is this growth percentage on all? Let us understand. So, firstly, we would take the redeemable value. We have to calculate the redeemable value. So, it would be higher of cash or the value of equity shares, right? So, we would calculate the value of equity shares and the cash would be 100 rupees because there is no data of premium or discount at the time of redemption, so it will be redeemed at face value if we take up cash. Now we will calculate the value of equity share. We had been said that we would get five equity shares for one debenture, and the value of one equity share is 22 rupees in the market, right? But the thing here to understand is 22 rupees price of the equity share is today. We would redeem our debenture after 6 years. So in 6 years, the price of the equity share would either decrease or either increase. Question says that the price of the equity share increases at a rate of 6%. Price of the equity share of the company grows by 6%. So it is natural that the price would go up by 6% every year for 6 years. So we would give that effect. We would raise it by 6% for 6 years. And here we get that 31.2 approximately would be the price after 6 years of the value of the equity share of the company. We would get five such shares of the company, which gives me 156 rupees as my RV. Right? Now, which one of this higher? Cash is 100 rupees, value of equity share is 156 rupees. So it is very natural that RV would be 156. PV is given to her. PV is given to us as market price is 120 rupees and there is a 4% flotation cost. Please mark it. People forget flotation cost here. So when we calculate this, we would get it as 115.2 rupees. So this is our PV, this is our RV, and interest is given in the question to us. Interest is of 12% and tax rate is of 30%. So now let us solve this question. So now this question is all normal. Just put the formula and we would get our answer. The 12% interest rate, 30% tax plus redeemable value is 156 rupees. Subtracted PV divided by life of the debenture 6 years, and we would take average here, right? So when we solve this, we would get our answer as around approximately 11.21%, which would be our cost of debt, right? So here we complete the topic of debt. There are three types of debt: redeemable, irredeemable, and convertible debt. I hope you're clear with all three of them. Redeemable debt and convertible debt as such does not have much difference. The only major difference is that when the debt is convertible, you have an option to convert it into equity shares. So you have to always calculate the value of equity shares and then calculate RV. Take the higher of cash and equity share, calculate RV, and then put it in the formula. And in a very similar manner of redeemable debt, find your cost of debt and the cost of debt is completed. Now, second one, let us start with cost of preference shares. To be very honest, cost of preference share is also very similar to cost of debt. There is just a very slight thing which you have to understand, and cost of preference share is very easy. Let us go back to the situation we took a few time back. Right. So when we observed this situation, we took the factor of tax just because it was reducing our, oh sorry, we took the factor of tax as the interest was reducing the tax and we were having tax saving and that affected our cost of debt. But when you observe preference dividend, the amount which we pay to the preference shareholders is preference dividend. So when we subtract preference dividend, it is subtracted from earnings after tax. That means preference dividend is given after paying tax. So it as such does not have any effect on our tax. So it does not reduces our tax and thus tax factor is not considered while computing cost of preference shares. So in preference share, it becomes very simple as such as we just have to consider the amount of preference dividend which we are giving, which is also pretty much fixed. So cost of preference share KP is nothing but preference dividend by PV. PV is exactly the same what we discussed above. Net proceeds, issue price, market price, and face value. This is the cost of preference share in case of non-redeemable preference share. When the preference share is redeemable in a very similar manner, preference dividend, difference between RV minus PV divided upon life of the security, whole divided by average of RV and PV. So this is what is the formula of cost of preference share when the preference share is redeemable. There is nothing much in preference share. This is just it. And we would solve one question of preference share and we would get a very clear understanding of it. It is very, very similar to that. There is nothing different in preference shares. Question number 4. SK Limited is a company which is issuing 10 lakh debentures of 10% preference. Sorry, SK Limited company is issuing 10 lakh 10% preference shares, face value of 100 rupees. These preference shares are redeemable after 10 years, and the cost of preference shares needs to be calculated in each of the following cases. So we have been given with face value, which is 100 rupees, and the life of the security is 10 years. The RV and PV are different in each of the cases, and we need to calculate the cost of preference share. The first case, preference shares are issued at par and redeemable at par. So the RV and PV are same. So this case becomes very simple. It would be just cost of preference share would be preference dividend upon PV. So here dividend is 10%, I suppose. Yeah, 10% dividend and 100 rupees is PV. So this would be 10% cost of preference share. In second case of our question, it says preference share will be issued at par but redeemable at a premium of 10%. So here RV is 110 rupees. So cost of preference share would be 10 rupees preference dividend plus difference between RV and PV divided by the life of the security upon the average of RV and PV. And when we calculate this, we would get it at around 10.48% approximately cost of preference share. In the third case, it is said that the preference shares are issued at a discount of 10% and redeemable at par. So here the PV changes, the RV remains 100 rupees only. So here it is 10 rupees, 100 rupees is RV, PV is 90 rupees and divided by 10. And here we would take average of both. So when we calculate this, this approximately comes to 11.58%, right? And then our fourth case where it is said that the preferences are issued at a discount of 10% and redeemable at a premium of 10%. So here, 10 rupees preference dividend plus 110 rupees is our RV, 90 rupees is our PV divided by 10. And here we would take average of both. And here we would get 12% as our cost of preference share. So this is very basic. Preference share is not very much difficult. It is very similar to debt. Once you understand cost of debt, it is very easy to understand preference share. And now this with this we complete preference share. I would attach one more PDF with this for extra questions. If you want to practice, you can refer to that PDF. And we would end our class today here, and we would cover the topic of cost of equity and cost of retained earnings in the next part of our video, which would come very soon. And I will cover all the types of cost and all the models of equity share and cost of retained earnings. And I would also cover the weighted average cost of capital and marginal average cost of capital also. So that will become in the second part. Please do subscribe our channel and like the video if you like the content. Thank you very much.